I have learned two things in the last 24 hours that I want to run by Mr. Jonathan Twomley, who plays in a very big space, multifamily, the big stuff, something I don't play in. These two things that I've learned will have an impact on that market, good or bad. We are going to talk specifically about Barry Habib's 6-month call for mortgage rates. And then second, we are going to talk about the percentage of bridge loans originated in 21, 22, and 23 that need equity injection. So those are going to be our two topics. We're going to start off with Barry Habib. Jonathan, welcome. How you doing, buddy?
I'm doing great, Michael. Good to see you.
Absolutely. So Jonathan, you and I have talked in the past month or so that my particular forecast for 2025 is 30-year mortgage rates will average 7%. They may dip below 7% when we kind of close out the year, but when you look at totality, it's going to be 7%, right? We have talked about that.
Yes, we have.
Well, Barry Habib, again, I want to give Barry Habib his flowers before it seems like I'm attacking him. Barry Habib, if you don't know who he is, I think it's Mortgage Highway, something like that. But anyways, he's been the Crystal Ball a winner 2 times, which is an award given to economists who correctly call the mortgage rates. So again, he has the track record. He has the hardware. He is the best in the business. So I'm giving him his flowers, right? I'm setting that up because he and I disagree. And either I'm going to look like a complete fool, which I'm completely happy with because it happens all the time, or he's going to be spectacularly wrong. Without hiding it anymore, Barry Habib's call for the 30-year mortgage rate in 6 months is 5.8%.
Wow. Okay. I thought you were going to say that it was going to be on the upside, not the downside. So I thought he was going to say like 11% or something, and I was going to go like, oh well, all right. I'm not sure how we get there, but okay. But 5%, like I'm with you. I just do not. I do not see it. What is his argument?
So his argument is basically a 2-step function. And again, we'll start with the base. So the key to Barry's call, in my opinion, is he sees the 10-year note reversing in a hard way, right? Anytime you're going to call a mortgage rate, you've got to look at the 10-year note. So the 10-year note, as of yesterday, I haven't checked this morning, had hit 4.7. Barry's call for 6 months is the 10-year note will hit 3.6%. So he thinks there's 110 basis points coming off the 10-year note. The second part of his equation is that the spread, which historically has been 180, it got as high as 310, currently sits at 260. That's going to come in to 225. So he thinks about 30 to 40 basis point is in spread collapse or reversion to the mean. But the heavy lifting is the 10-year note collapsing to 3.6. So that's how he got there.
And what's the basis for him thinking that the 10-year is going to collapse? That's what I don't get. I can see spreads coming in because I think if interest rates are stable, if the banks see them as being stable, then the spreads will come in. The reason that they've been so volatile and why they go so high is because the banks need to build an extra cushion. But if the banks say, look, we believe that the rate is going to be 5% for the next 10 years, we'll give you a pretty decent spread on it because we don't have that much volatility to worry about. But so I can get that piece of it, but I don't understand the rates coming down.
Basically, his opinion is kind of multifold, but the lion's share of his opinion is, as you know, the 10-year note has gone up 110 basis points since the Fed started cutting. That's kind of the fly in the ointment. Basically, what Barry is saying is that's been an overreaction. That rise in the 10-year mortgage rate of 110% while the Fed cut 100 basis points was kind of a market freakout. And as the new administration comes in, as the unknowns become known, that, again, overreaction or, spike will come in, and we will just get back to where we were, which was 3.6%. That's his thesis.
Well, that actually sounds a little more plausible, right? If you characterize the rising rates in response to Fed cuts as being unreasonable, and we're just going to kind of go back to where we ought to be, that does not sound unreasonable to me. If that's the reasoning.
Yeah, it is it's a wonderful argument. And And basically, the thing that got me about Barry's call wasn't the 5.8. It was in 6 months.
Yeah.
That's where it just felt like too much too soon. Because when I think of Q1, Q2, there's good, like, all these unknowns will become knowns, but I'm not sure they become known in 6 months, right? It's just like, that's awful soon.
I do think a lot of Trump policy will be known by then, though, right? Sure. So if they're able to push through tax cuts or whatever they want to push through, tariffs, like all that stuff, we'll know in 6 months whether it's gonna happen or not, right? Because either Congress is gonna, the Republican Congress is gonna say, okay, fine, Mr. President, you get what you want, or somebody's going to fight him on it, and then the whole thing is going to, it'll be clear that he's going to have a much tougher time than people think. So, I think within 6 months we'll know which is which. I guess my doubt on this, I guess, is still so much of what's being proposed is really inflationary, and so that's what I think the headwind against this really is, right? And maybe I think one reason why, the market has reacted the way that it has is because Trump won, so that's a certainty, right? Mm-hmm. They know what his proposals have been, which are inflationary. Plus, the Fed cutting rates is inflationary, right? Mm-hmm. So it's the market saying, hey, hold on here, we don't buy this, right? We don't buy that this combination of things is going to lead to lower rates. So I still think that all kind of holds true. Mm-hmm. And so I mean, wait and see what passes, but at least if what has been proposed passes, I just don't see how those things are not inflationary.
Yeah, no, it's funny you bring that up, because one of the noticeable things that happened this week is the betting markets on future inflation have taken a noticeable rise. In fact, on Monday, expectations for future inflation were pretty constant at 3.6%. This week, I think starting Tuesday, they started to move up and are currently sitting at 4.1%.
Wow.
So again, a lot of people are looking at what's coming and going, this has to be inflationary. And if we see that second bout of inflation like the early 80s, the next Fed move could be up, not down.
Oh, I mean, listen, I think if we see inflation come back, I think the Fed is going to be even more aggressive. I mean, it won't be like 25 basis points hike to kind of show the market we mean business. It's going to be like a point, like, I mean, it'll be big. And
it'll be big. It'll be an emergency cut. They will make a point out of surprising the market, I think.
Yeah, I agree with that. So, I mean, hopefully it doesn't come to that, but I mean, populist politics are inflationary. Just, we know that looking around the world, right? So that's kind of what I think the market is looking at too.
Yeah, again, my biggest fear, and it's been this way for 18 months or so, was that second repeat of inflation, right? We don't have to go back to 9.1 to kind of repeat the 80s. I mean, if we go back to over 4, that's enough to, need to Paul Volcker this thing, right? And again, Paul Volcker basically came in after Arthur Burns screwed it up and said, all right, damn the torpedoes, we're going to break the back of inflation, screw the job market. And, the 1982 recession was nasty.
Yeah, I mean, it'll be really interesting to see, though. Let's just say that so Trump gets what he wants. Mm-hmm. The stuff is passed.
Yep.
It is inflationary. The Fed looks at this and goes, we got to raise rates. And then Trump freaks out on Powell. And then you start, and then what does that do to the markets? I mean, because I don't think that the markets, frankly, are going to be all that happy with like the threat of somehow Powell being replaced by some easy money Fed chair in the face of all this inflation. Then I think, we get the stagflation, the runaway inflation, and everything that people have been concerned about. I mean, I just can't imagine what would be worse for the economy than having both, not only inflationary fiscal policy, but intentionally inflationary monetary policy in the face of the inflationary fiscal policy, right? And basically saying like F you to hard money people, right? So,
Yep.
yeah, I mean, let's hope it doesn't get there, but
yeah, it's going to prove to be interesting. So again, Barry Habib has all the hardware. I think he's a wonderful forecaster. I watch his stuff, and 5.8 6 months. So if you are a real estate agent, a mortgage broker, you probably are worshiping and praying that Barry Habib is right, because that will certainly get transactions going.
Well, we should put a calendar tickler for 6 months.
Yeah, absolutely.
And come back on our show 6 months from now in July.
There you
go. See if he's right.
Yeah, we'll do it the July 4th week, whatever that is. That'll be roughly 6 months. All right, now number 2. So you and I, or at least I've been pontificating just how bad the bridge loan market would be. We obviously know there is a lot of pain or stress. I put it out there on the Daily Financial News yesterday or the day before, talking about it. And a bridge lender reached out to me privately and said, Michael, this is my space. I've been in it for a long time, yada, yada, yada. You can't use my name or my company. But by my book of business and relationships, he is estimating that bridge loans originated in 21, 22, and 23. 50% of them need equity injection to facilitate a refinance. So let's talk about that. That's a whole bunch of words. What does it really mean, Jonathan, for people who own these properties, staring at a refi, needing an equity injection to get a refi? Break it down for us.
Yeah. So what it means is when interest rates, there's an inverse relationship between interest rates and property prices, right? Especially since in the commercial markets, the price of the property is really driven by the return that you expect to generate. And the lower the interest rate, the higher the return that you think you're going to get. I mean, ultimately that arbitrages itself away. But what winds up happening is prices for property go up, right? All things being equal. So what has happened was that people got very excited about very, very low interest rates. They basically think of these things in terms of like the spread of the cap rate versus the interest rate that allowed them to bid even more for property. Property prices hit all-time highs in 21, 22. And then what happened was when interest rates went up, it just, the whole thing unraveled, right? And so just from a mathematical basis, as interest rates went up, since you have that inverse relationship, it just caused prices to go down. Now, what happens is when you go to refinance, right, when you want to take out that bridge debt, and we'll talk also, I mean, this really doesn't matter what the form of debt is. It just happens to be bridge debt because that was all that was available at the time, or that's what people were using because in addition, well, let's talk in a minute, just put a thumbtack in this about why it's even worse because it was bridge debt. But basically bridge debt or no, it doesn't matter. As the interest rate goes up, right, it means that the property is less profitable. So you'll at those interest rates. So you have to pay less so that you take a smaller loan, right? So that you can afford the cash, the cash flow from the property will pay. So what that means is when these loans, when the term is up, right? If the property is less than it was, worth less than when you paid for it and you go to refinance, that means that in order to pay the debt that you have existing on the property, you're going to have to come up with cash to give to the bank because the property is worth less, right? So people are doing cash. You won't be able to get the proceeds from the next lender that you need to pay the first lender without topping up cash. And on top of that, so now we'll talk about why the bridge debt made it even worse. Lots of reasons. But for example, traditional lenders on commercial property are only going to finance 65, 75% LTV. The bridge debt lenders were going higher than that, right? So not only were they going higher, but they were expecting lower coverage ratios, which meant that people could bid even more for the property. So it actually exacerbated the upswing. People paid more than they would have even though they would have paid a lot more with traditional debt. The bridge debt just like unlocked the crazy, right?
Yes, for sure.
So now traditionally when you refinance, the most proceeds you're going to get is 70%. So even on a purchase, let's just say you're going with regular like Fannie Freddie debt, you get 75% loan to value right? And then and let's just say it was interest only, right? And inflation was 0. So the property is worth exactly the same as it was the day that you bought it after 5 years. You would still have to do a cash in refi.
Yeah, for that 5%.
Because for that 5%, right? Now, typically what happens is your NOI grows, the property is worth more, the 70% more than covers the original 75%. You had some principal pay down. Right. You're good. You're probably returning some money to your investors. Everybody's happy, right? However, with bridge debt, you're up at 80% LTV, right? And and that 80% is based on a bigger value because you overpaid, and everybody is overpaying because of the proceeds that were available. Now you come back and you're looking at 70% refi proceeds, right? The property is now worth a lot less, and you're only getting 70% of that, right? Property is worth less probably than the original debt was, right? Yeah. So, and then you're only going to get 70% of that number. Yeah. That's why people have to come up with cash. So what we're going to see is a lot of LPs saying, no way, I'm just writing this off, and these deals are going to go into foreclosure. And I'm not surprised at the 50% amount just because of the math. I mean, I've heard anecdotally about loan pools where 100% of the assets are underwater. Yeah. Right. So
this could be bad. I mean, the last thing to kind of talk about this is like what you said earlier, the crazies come out. I would also say the LPs were crazy because they just started believing I mean, I've been an accredited investor for 10 years, and the stuff that I saw from 21 to 24 were some of the most absurd assumptions and evaluations. And it's like, this is nuts. And they raised money in 24 hours.
Oh yeah. I mean, listen,
crazy.
When you have this kind of rising market like we had, where people were, making money really fast, that gives people a false sense of security, right? Yeah. So either LPs made money themselves in a deal they invested in, they made more money than they thought in a shorter time, and they're like, hell yeah, I'm reinvesting.
I'll do this again. Yeah,
exactly. But everybody bought into it, right? Well, I don't want to say everybody because there are a couple of people on this call who didn't, but like exactly. But like everybody bought into it. The crazy thing to me is that the lenders bought into it too. Like you would think, now some unsophisticated LP who has never invested before sees their buddy make a lot of money, and they're like, hey, you got to do this. Right. Yeah. I get how that person kind of gets swayed by the frenzy. What I don't understand is the bridge debt lenders who are supposedly sophisticated people, right, who went along with this whole thing thinking that, essentially it was free money, and they were all, so this is just the greed. I mean, listen, greed is powerful, right? Greed just really made people lose their minds.
No, it's sad. And I've actually spoken with a couple of LPs. One LP I spoke with personally, he was in his first syndication. I think it was 18 or 19. It went really well. Like you said, he got more money faster than he expected. And by the time 22 came around, he was in 30 syndications, right? That's kind of, hey, some is good, more is better. And he said 20 of the 30, in his opinion, were already worth 0.
Wow.
The other 10 he had hope for, but it was more of they're just going to limp along, no distributions for 5 to 10 years, and maybe he'll get his equity back. That was kind of the good side. I was like, yeah, oh my God, this is terrible.
I mean, I know people in similar situations who rolled over, they rolled the money over. That was the thing, is nobody took chips off the table, right? So they rolled it over, and in 20 syndications, that by 2022, when interest rates started going up, and since all the deals had been done with floating rate bridge, distributions were stopped on all those properties, right? Yeah. And I'm sure, like anything that you bought at the top. Now, I used to argue, so just going back a few years, when my Facebook group was really active, I used to argue with people, and this is even before COVID. I used to argue with people. There were people who said, you have to do 1031 every single time. You must not have any uninvested cash. And I would say to them, look, here's the scenario. Would you prefer to, take your chips off the table at the top of the market, right? pay the 20% capital gains, 25% capital gains, or whatever it is, and then it's only on the gain, right? So you've now got this bigger pool of capital to invest, right?
Yep.
And would you rather do that, or would you rather double down and then lose it all when the market crashes? And then everybody was like, you can't time the market. There's all these justifications for why they shouldn't be cautious, right?
Yeah.
And it just would make me crazy. Like, people, you have to say, it's like they're putting the tax cart before the profit horse, and it just never made sense to me. And nobody wanted to listen. And just sorry, one more thing, because I'm on like a high horse now. I was on a panel, right? I was on a panel, and 2019-ish, where I said on the panel, hey, look, I believe the market is frothy. I think people need to be cautious. And, I was told by a very prominent syndicator, multifamily will always go. I mean, literally said, it cannot go down. I said, why can't it go down? He said, well, because there's a housing crisis and because of the federal budget deficit. And I said, none of that matters. It can still go down. I've seen it go down before. It can go down. He said, it cannot go down. Well, that guy's had at least one foreclosure so far. And the scuttlebutt is his entire portfolio is in trouble.
I think I know what you're talking about. And it's they're not doing well. Yeah. I mean, it is absolutely predictable. And the beauty about having this YouTube channel is it's all documented. I mean, I think it was 18 months ago, you and I did a famous video where we turned a $100 million building into a $48 million building. People thought we were crazy. Dude, that was easy to do.
Yeah, I think it was a little longer than more than 18 months. But yeah, I mean, that's just how the math works, right?
It's just math. Yeah, it's just math. I need to create a shirt that says it's just math. Yeah, and the really funny thing is, the other thing I feel good about is, I've been through multiple cycles now, and both times I got out of the way, right? Yeah. In 2006, I sold all my single family homes and bought multifamily. Why? Because of the greed and stupidity and lending and all of those things. And then in 2019 and 20, I sold, my worst performing apartments because, cap rates were supposed to be 8.5, 9. I sold just below 6. So they went all the way to like 4.5. So I sold early. I sold early both times, but I was out of the way.
But listen, I saw this somewhere. I wish, someday I'll try to dig this up, but somebody actually mathematically demonstrated that it is better to sell too early than too late.
Oh, right? Absolutely.
And so, and so it when I sold my portfolio in 2019, I sold it because people were willing to pay me way more than I thought those properties were worth. Right now, if those guys sold in 2021, 2022, they made money.
Oh, they made money.
No doubt. Right. And if I had held it longer, I would have made more money. But the fact of the matter is, if I'd held it too long, I'd be like upside down. And I sold, people were telling me, you can't time the market. You can't time the market. I was like, I'm not trying to time the market. I just think these people are worth, the market has gotten to the point where people are willing to pay me more than I think these are worth. Yeah. And that's a signal, right? So you can, when you say you can't time the market, I mean, what that really means is you can't time the absolute top. Nobody knows the top until the top is passed. However, you can look at the market and say, this is a buyer's market. This is a seller's market. This is an extreme buyer's market or extreme seller's market. And when you're getting into the extremes on either side, that's when you have to start doing whatever the opposite. Look at what everybody else is doing and do the opposite. And you may lose a little bit of upside because you weren't greedy. That's where that old expression of the bulls and the bears make money, but the pigs get slaughtered. Yep. It's the pigs who are trying. The pigs are the ones who say you can't time the market, but they're trying to. They're like, let it ride a little more. Let it ride a little more. Yeah. There's still some way to run. Let it ride a little more. Yeah. That's market timing. And that's the people who lose. And those are the people who rolled over at the top and now we're looking at losing not only like the gain, but the original principle in the first place.
Yeah. Well, this is why I still speak at events because I want to see, obviously I want to help people, but I'm there to actually see what the audience is doing or excited about. Right. I went to a San Jose event. We've talked about it where, some brand new syndicator raised millions of dollars in the room while I was standing there. And he never owned anything. And I'm like, oh, this is a problem. And then like in 21, I was at another event being the long-term landlord guy, and some Airbnb host got up and started talking about how short-term rentals are the wave of the future. And everybody, right? So they weren't talking to me; they were talking to them. Like, oh, this is going to be a bubble. I just watch people's behavior, and when I see the stupid people think real estate is easy, I run the other direction because it's going to be a problem.
I mean, really, anybody saying real estate is easy, that's always a bad signal.
When the masses do that, problem.
But listen, this is not new. This is the Joe Kennedy shoe shine guy giving you stock tips thing. I mean,
out of the way.
It's every cycle. It happens every time. The cycles, the upswing is long enough that you have time for people to get into the market who have no memory, who have no history, right? And even for people who do, I mean, I think that there's always still psychologically this fear that, well, maybe this time, maybe interest rates are going to get permanently stuck at zero. And that's because people were talking about that sort of thing, right? They were talking about how, well, the Fed is going to have to go negative on interest rates.
I remember.
And so when there's that kind of talk happening, I think it's very difficult to maintain your discipline. I often find it ironic, though, how it's often the very same people who are like, on the one hand, screaming about, well, if the government does this, inflation's going to happen. And then on the other side of their mouth, it's like, but interest rates are going to go below zero. And it's like, okay, well, both of those things can't be true, right? So
the big question I have now about this 50% of bridge debt needing equity injections, you're absolutely right. You've painted the timeline. We know what the end of this is, and that's a lot of foreclosures and banks getting keys. The problem or the riddle I'm playing with is how long is the fuse? And when does this stuff start showing up in bigger numbers? Class A's retrading, B and C are not. So what do you think?
So, I mean, listen, just for historical perspective, the bottom of the commercial market after the GFC didn't hit till 2013.
Exactly. It was years. Yep.
And it's the same process because everybody's trying to kick the can down the road to like hope that it's going to get better, until they finally throw in the towel. And it's only when they throw in the towel that you start, you get price discovery, the market bottoms out, people kind of can really get a read on things. I mean, who knows? This time it could be even worse because in the great financial crisis, everybody rushed to foreclose. And this time everybody is holding that off, right? But I do think that I think the bridge debt is really the key to all of it. Right?
I do, because that's a different type of capital. This ain't Fannie Freddie stuff. This is very short term money that has a clock on it. It's got to be returned to investors. Yeah, they can only go so far, and I don't think they can go much farther. Right? They've already given them a year. We've got something like $2.5 trillion just sitting there waiting to be booked. Mark to market. And I think worst case from timing, it's 26. I think you could see some of it late 25. What does that feel like?
Yeah, I mean, I think some of it is because listen, you've already got this is 2025, so 2020 vintage loan debt's coming due, and if it was a 3-year debt with 2 years extension that's coming due, maybe they can get another year. But I think that a lot of times the negotiation that has to happen between the lender and the borrower is the borrower is going to say, you can't make me pay for a rate cap, right? You have to waive it. Just can't. I can't afford it. You just got to extend.
There's no money.
You just got to extend me without a rate cap. And that's the fight, right? And the lenders, of course, want the rate cap, but it's like blood from a stone. If the property is underwater, people are not going to pay LPs are not going to pay the rate cap, and they're going to be like, okay, foreclose on me then, right? So, but yeah, I see that the bridge debt bomb ticking.
It's coming. The fuse is lit. The only question is how long the fuse is.
And here's another sort of wrinkle on all this. One of the things that I have noticed is that a lot of people who were syndicators are now raising debt funds, right?
Wow, that makes sense, but it's kind of sad. But yeah,
right. But I mean, in the worst situations, they're raising debt funds to fund their own deals, which they're to fund their underwater deals. Which like, please don't invest in those if you see them.
Yeah, don't invest in those.
Just if you see like a syndicator that you know of who's raising a debt fund, like get to the bottom of it, make sure that this is not investing in their own deals, because that is absolutely going on right now. But even that aside, the banks are pulling back on lending, right?
Yes,
and
exactly. Yeah.
So there's all these people rushing into the debt fund space because they think, okay, well, here's the opportunity. But guess what, folks? These debt funds are lending out at like double digit interest rates. They're not lending out at 4%.
No,
right?
It's 10, 11, 12. Yeah.
Yeah. So when they come and they say to like, hey, you, Mr. Distressed, owner who needs to refinance, right, we'll fund your deal. But when you do the numbers, it's like 40% of the loan, right? That's outstanding. So, and on purchase too, if anybody's going to use these debt funds to purchase property, they're only going to be able to pay pennies on the, like, I mean, listen to this. I'm going to phrase this very particularly. They're only going to be able to afford to pay pennies on the dollar for the on that loan or on that property, right? So
I remember paying 12, 13, 14% for money when the bank stopped lending. And again, if I could, I'd be really clear. I would pay 20% if I could get a deal that made sense and penciled.
Yeah. I mean, listen, I've thought about this a lot because, you and I were kids when mortgage rates were 20%, right? And I always think like, man, if you had bought a piece of property at a 20% interest rate that made sense at that time.
That worked. Yeah.
That worked. You just like were loving life for the next 40 years, right?
Yeah, 40
As interest
years,
rates
absolutely.
just continued to tank. Now I think, listen, and going back to sort of what Mr. Habib said, are we in a different interest rate cycle where it's up now, right? I mean, clearly that lowering interest rate cycle is over, and now what are we in? So
yeah, I've been on record. I think we're set up to repeat the early 80s, which means higher rates for longer, but eventually go look at the charts of the 80s, the rates start coming down. And that's funny. I just on the Daily Financial News, shout out Mike Simonson for this. He said that of the mortgages outstanding today, I'm going from memory, 17.2% of them are over 6%. And as rates stay longer, that number only goes up.
Right.
So what does that mean? That means the longer that this happens, the move-up market will start to work again. And by the way, the refi market is just building this base of kindling that will explode into an inferno sometime in the future when rates go sub 6.
But who knows how long it's going to take? I mean, so
That's
because
the key.
I mean, if you look at history, right? So interest rates rose. They had to spike very high to tame inflation.
There was about a 4-year run from 78 to 81 where rates were on this cycle.
Yeah. And then they started coming down, right? But it took them a long time to get, even down below.
Yeah, below 10. It took like 4 or 5 years. Yeah.
Yeah. And there were a lot of other things that were happening at the same time that I think also contributed to it, which people don't really focus because it was running in the background. But one of those was there actually was a serious attempt to get the federal budget deficit under control under Clinton and Gingrich, right? And that worked. And I think that kind of reset people's thinking. Like even though Bush then came and blew it all out of the water with all the wars and stuff, like that kind of like reset, like, well, we can kind of control this,
we can, right? We can bring that thing down.
We can do this, right? So I think that kind of reset, that was one thing that was running in the background. You had Greenspan also, who was constantly like trying to constantly test, like, what's the lowest interest rate? Like, what will not cause inflation, and constantly pushing the border. And then the other thing was we had the massive, offshoring of manufacturing to China and other parts of the world that kept prices low, right? That's over, right? Yeah. So, I mean, we've given up on the federal budget deficit. Clearly, like
$1 trillion a year or something, or 9 months, or whatever it is.
But we've given up because now, the Republicans are coming in. They're the ones who are supposed to be the budget deficit hawks. They're clearly not interested, right? They want to use like accounting gimmicks to make it look like, we'll make it a 5-year tax cut rather than a 10-year tax cut or whatever to fudge the numbers to make it look like they're not increasing the deficit. But clearly there's no serious effort by anybody now to tame the budget deficit. That's gone, right? Offshoring is over, right? Everyone's you're trying to reshore,
yeah.
Or at least near shore or whatever, but like that. But anyway, it played itself out anyway. Like the huge benefit that we got from lowered prices. Well, now these are the prices, and they can really only go up from here, absent like massive automation. Like the next thing may be automate manufacturing of everything, but then who knows what that what impact that has on wages, right?
Yep.
So I think that we just had this kind of golden era of a lot of different tailwinds that really helped keep, inflation low. And Greenspan took credit for it, other people took credit for it or whatever, but it really wasn't just one thing. It was a bunch of things that happened at the same time. And now that combination of factors is gone. I think if you take any one of those pieces away, it doesn't work. Right. So I think that we're in if not a flat cycle, a rising cycle for some time now, because it's going to be some time before the next kind of good, massive macro good news happens that causes us to go into an easing cycle. But I think that we're not in an easing cycle anymore. And I think if you're expecting us to be in an easing cycle, I think that you're going to be disappointed.
Yeah, this is always fun to talk about. Again, we've got Barry Habib's interest rate call of 5.8%. We've got 50% estimate, 50% of bridge debt blowing up. We've got a fuse lit because LPs are not going to be adding equity injections. We got a lot of fun coming in the commercial space. Jonathan, where can people find you?
So I run this group on School where I teach all this sort of stuff. But also I want to let everybody know, I didn't even tell you this, Michael, because I forgot. I'm running a 2-day workshop February 3rd and 4th, which is free, but there's only 20 people, so you do have to apply. If you would like to get a spot in this workshop, hit me up on LinkedIn. It's probably the best way to get in touch. I'll send you the application. I mean, it's not complicated, but I just want to make sure that the right people are there and people for whom this makes sense are there. So February 3rd and 4th. So just like I said, come to LinkedIn, let me know.
Very cool. Jonathan, you're amazing. Thank you so much.
Thank you.